Hello, everyone. Just waiting a moment as people are getting their cameras connected, and we'll just get started. Okay. So thank you, everyone, for joining us today. This is the Sound Solutions webinar event with the Greater Manchester Chamber of Commerce. Every quarter, we host a new roundtable discussion or webinar on a solution-oriented topic. And so this month, for the month of January, we have Karl Badey from MMNT Certified Public Accountants and Marc Finer of Murtha Cullina joining us today to talk about the tax implications of the 2020 presidential election and 2021 strategic tax planning and updates. And so before we get started, they have a great presentation for everyone today. And I just want to give a little bit of background about our speakers. So first up, we have Karl Badey of MMNT Certified Public Accountants. Gave a nice wave for everyone. Karl is the tax services partner at MMNT. He is also responsible for educating the firm staff on current tax laws, regulation, requirements, and practice standards. His areas of expertise include tax planning, corporate and partnership tax returns, estate planning, IRS and DRS audit representation, and transaction planning for business acquisitions and business succession. And also joining us today, we have Marc Finer, who is a partner at Murtha Cullina. And Marc provides effective and innovative federal tax, multi-state tax, and business planning solutions for corporations, partnerships, limited liability companies, investment entities, and individuals. Marc regularly advises clients on federal, state, and local income, compliance, and reporting tax issues from operating businesses and investments. So I hope that everyone's ready with their thinking hats on today and getting their questions ready for Marc and Karl. We ask you to please hold your questions until the end of the presentation. And if you'd like, feel free to put them in the chat box, and I will address them at the end of the presentation in the order that they're received. Thank you. And so without further ado, I'm going to pass the microphone over to Marc and Karl, and we'll begin by sharing their presentation.
Great. Thank you, Emma, for that introduction. And thank, everybody on the call. You could have been anywhere right now. So we appreciate the fact that you've decided to spend the next hour with Karl and me. So in the next hour, we're going to take you through some provisions of the CARES Act that were enacted in March of this year. We're also going to take you through when we think tax reform will be enacted, if it will be enacted, and the makeup of the federal government, Congress, the president, the House and Senate. We're also going to touch upon the new stimulus package that was passed at the end of December and talk about just some planning strategies that both relate to the stimulus tax reform that was enacted in March and December, but also just some general tips to be thinking about based on the potential tax reform that Joseph Biden, as the new president, now I can say as the new president, is proposing. So next slide, actually next couple of slides. So first, we're going to just talk briefly about the CARES Act that was enacted in March of this year. A couple of big things for businesses were, one, the employee retention credit, and that provided employers with a refundable credit against 50% of qualified wages paid to employees through the end of December of last year for employers who experienced some sort of shutdown as a result of a government order or a greater than 50% reduction in gross receipts, all related to COVID challenges. And the credit is given to the employer through a reduction in the payroll tax deposits that are withheld from employee wages. So instead of paying those deposits to the IRS, the employer can actually use those payroll deposits to reimburse itself for payment of wages to employees. delay in employer payroll deposits. I don't know if you remember, but President Trump allowed eligible employers and self-employed individuals to delay the 6.2 employer portion of Social Security attributable to employee wages through December of last year. That's actually been extended from April to the end of this year, when those deposits have to be actually made to the IRS. Expanded NOL provisions. So NOLs generated in 2018 through 2020 can be used against 100% of taxable income in those years, and excess NOLs can be carried back for up to 5 years. And that's a change from the Tax Cuts and Jobs Act, which I'll just refer to for the rest of the presentation as the TCJA, that allowed post-2017 NOLs to offset only 80% of income, and prevented the ability to carry back those NOLs. Acceleration of alternative minimum credits. The Tax Cuts and Jobs Act, TCJA, did away with the corporate alternative minimum tax, but people had credits from the payment of this alternative minimum tax that under the TCJA could be used between the years 2018 and 2021. The CARES Act allows those credits to be used in 18 and 19, 50% in each year, or actually claim the entire credit in 2018. Next slide. Business, so there was the CARES Act provided for a temporary increase in the business interest deduction under the TCJA. Business interest expense could be deducted to the tune of 30% of taxable income. The CARES Act allows interest expense to be deducted to the extent of 50% of taxable income for the years 2019 and 2020. The corporate charitable contribution deduction threshold was increased to 25% under the CARES Act. That was extended, that was for the year 2020. That was extended to 2021 by actually the new stimulus that just came out. Qualified improvement property, the CARES Act changed a mistake that had been inserted into the TCJA that prevented certain property from being eligible for bonus depreciation because it had a 39-year life. The CARES Act changed the life of those assets to 15 years, which made it then eligible for 100% bonus depreciation. One of the biggest things to come out of the CARES Act was PPP loan program. That program said that the forgiveness of the loan, which would ordinarily be treated as income to the borrower, is not taxable income. And lastly, excess business losses. The TCJA limited business losses to taxable income plus $250,000. The CARES Act said that limitation does not apply for the years 2018 to 2020. And you may be asking yourself, why am I telling you about stuff that, related to the years 2018, 2019, and 2020? We're now in 2021. And the reason I just bring it to your attention is because there are opportunities to amend your return for the prior years to take advantage of some of this, the tax benefits afforded by the CARES Act. And Karl, I don't know about you, but have you seen clients come back to you and say, I have NOLs for 2020 that now I want to carry back?
Yeah, I actually am working on a 17 carryback right now, carryback to 2017. It looks like he's going to be saving about $20,000 from the NOL carryback, which again came through the CARES Act. I also see people asking about the qualified improvement property, the accelerated depreciation on that, to try to go back and get some dollars from before.
Yeah, so I would recommend if it's worth a conversation with your tax advisor to see if the CARES Act would enable you to create some tax savings for prior years. It's out there, so you might as well try and take advantage of it if you can. Next slide.
Okay, so before we go too much further, let's look at the political landscape real quick. I know the slide that says Joe Biden will be the next president. I think he's the current president. I think most of Americans has accepted that. At the time when we made the slide, we weren't sure. But he has the president, right? The Senate is 50 Democrats, 50 Republicans. We know that the vice president controls the tying vote, and the House is under Democratic control. Basically, why I'm telling you this is two reasons. One is there's probably a better chance that Biden will get his proposals through because he's got essentially control of the House and the Senate. But keep in mind that the Senate is just a small margin, so you can get one dissenting Democratic person and it will blow the plan. So next slide, please.
I would also say before you continue, one thing to note is just because it's 50 Democrats, it's actually 48 Democrats and 2 independents. It's not a slam dunk that every Democrat is always going to vote lockstep with, all of the other Democrats. So it may not be just getting some Republicans to cross over. It may be, retaining that 50 member Democratic member balance in the Senate.
Agreed. And that's the point where they only need 1 or 2 votes is where people, senators start going, well, all right, put this little pork spending into the part and I'll vote for it. So it gets a little sloppy. I agree.
The bridge to nowhere, right?
Yeah, exactly. So Mark had talked about the TCJA, and I wanted to go over some of the key provisions. This is the Tax Cuts Act that was passed effective for 2018. I just want to remind everybody what some of the things in it were. So we got 10 different things here, just real quick. It basically lowered the income taxes, again, somewhere between 2 and 3%, depends on what rate you're in. It also lowered the corporate rate from a graduated structure to a flat 21%. I can't remember off the top of my head. 21, thank you. It established qualified business income, which is essentially a 20% deduction for business income that's not through corporations like S corporations and partnerships, to kind of equate it to the lower corporate tax structure. It increased the federal estate and gift tax exemption to over $11 million. So, and with a portability clause in there, couples can basically die with over $22 million worth of stuff before they pay an estate tax. Not necessarily applicable maybe to this audience. They established the new global intangible low tax income. That's essentially for companies that situate intangibles offshore and then pay royalties to the offshore entity. I don't think it applies here. They expanded the accelerated depreciation with 179 with up to $1 million, and then bonus depreciation, which you can even create a loss with that. It eliminated corporate AMT. It's essentially gone right now. And the one that's in the bane of everybody's existence in Connecticut is the $10,000 state and local tax deduction limitation. So between your car tax, your real estate tax, your income tax, you can only deduct $10,000. It also changed like-kind exchanges real quick. You used to be able to do it for equipment. Cars was a very popular one. I'm trading in my Lexus for an Acura. Now it only applies for real estate. And then the last one was it established qualified opportunity zones, which, long story short, it was a way to invest in distressed areas and basically get out on the backside with very limited tax. Next slide, please.
So it's important, that Karl went through that because it will be helpful to the discussion of changes that Biden has proposed with regard to individual business estate planning and retirement tax provisions of the code. As Karl said, the current the TCJA lowered the current highest income tax rate for individuals to 37%. Keep in mind that that's only through 2025, and the TCJA, when it was enacted, with respect to the individual income tax provisions, a lot of those provisions sunset, that's the term we use, after the 2025 year. 2025 tax year, and then go back to where they were in the 2017 tax year. So what Biden would be to restore the top tax rate to 39.6%, which was the pre-TCJA tax rate for individuals earning $400,000 or more annually. And you're going to hear a lot about this number of $400,000. And that's because Biden has said, if your income is less than $400,000, you will not pay any more tax under any of his tax reform proposals than you are currently. What he has not said is who that $400,000 applies to. For example, does that apply to filing, as a single filer, such that married filing jointly, that number might be 600 or it might be doubled to 800. We don't know what the answer to that is yet, so to be determined. Another proposal, long-term capital gains that are triggered when you have sold an investment you've held for more than a year, and dividends you receive from companies are currently taxed at 20%. Biden proposes to increase the long-term capital gains rate and qualified dividend rate to that same 39.6% for individuals earning more than $1 million annually. And again, we don't know whether that's for a single filer, such that that $1 million may be increased for married filing jointly. That also remains to be seen. Karl talked about this 20% qualified business income deduction for self-employed and owners of pass-through entities. And essentially what that means is if you are a partner in a partnership and you receive a distribution of $100 of income for a particular year, you may be able to pay tax not on that $100, but on 80 of that $100, because you're allowed to deduct 20%, $20 when you figure out your taxes. That deduction phases out for owners of certain businesses, primarily professional service businesses. So unfortunately, they were thinking of me because law firms are subject to that phase out, and Karl because accounting firms are subject to that phase out. Biden would phase out that deduction for all individuals earning more than $400,000, not just individuals that are owners of certain types of professional service trades or businesses. Next slide, please. Keeping with the individual income tax, right now taxpayers can deduct the greater of the standard deduction or their itemized deductions without any limitations. And again, that's one of those provisions that sunsets after the 2025 tax year. Biden would phase out the itemized deductions for individuals earning more than $400,000 and restore what's called a P's limitation. And it essentially cuts back on your itemized deductions for high income taxpayers. Keeping with that same theme, Biden would limit itemized deductions to 28%. So what does that mean? It means for individuals that are in high tax brackets, primarily 32% and above, just to give you an example, a high income earner would have its final dollar of income taxed at 39.6%, but only could take an itemized deduction equal to 28%. So there would still be some leakage in terms of the ability of that deduction to cover the income. The SALT deduction, this is actually really more of a Democratic push rather than a Biden push, although he has said he would be on board with it if it came to his desk. And another big one is currently right now, there's a 12.4% Social Security tax imposed on for 2021, the first $142,800 of wages, and that 142,800 is indexed for inflation. So it was less last year. It will likely be more this year. Biden would impose that same 12.4% Social Security tax on wages in excess of $400,000. So when you think about it, what does that do? It creates this, what we describe as a donut hole. you'd have this 12.4% tax imposed on the first 142,800 of wages, and then again on $400,000 of wages and above. But when you think about it, if the $400,000 is not indexed for inflation so that it's static, that 142,800 over the years will creep up to $400,000. And essentially what that will do is all of a person's income will be subject to that 12.4% Social Security tax. Thereby, the donut hole would be eliminated.
Mark, I would assume that small businesses would not pay their family members more than 400 for the near term anyway, if this passes.
Yeah, I mean, and that's something we may, we'll get into a bit later. It gives you a reason to think about comp and how much you're paying, and whether there are other ways to pay compensation without it being treated as compensation,
right,
for purposes of this 12.4% tax. Maybe it's offering a bit of equity in the company instead of dollars to avoid this 12.4% tax. It may you may want to think about deferred compensation to avoid or minimize, I should say, this 12.4% tax. So the next slide. So right now, just a couple more things. There's no credit for first-time home buyers. Under Biden, first-time home buyers would receive a credit of up to $15,000, and the credit would be refundable and advanceable. And admittedly, I had to look up what a refundable and advanceable credit was. And essentially it is, you don't need to wait until you file your tax return to get the credit. And you also get the credit even if your tax liability is not equal to or greater than the credit. There's some child care credit and dependent care credits that he would raise the amounts that would be available under those credits. Plus he would add under the child credit, an additional $600 for children under the age of 6. Next slide.
Okay, so on a corporate, by the way, on just a side note, I'm pretty sure Biden's doing this because my youngest child is in college, and by the time this passes, I will be ineligible for any child tax credit. So
yes, and I said to Karl, yes, I've heard some commentators specifically cite his name as the reason that Joe Biden is proposing this.
I'm a little bit bitter, yes. So anyway, on the corporate tax side, he's proposing that the flat tax, which again is currently at 21%, he's proposing to raise this slightly to 28%. I'll call it slightly, it's a third, but slightly. And then the provision that says no alternative minimum tax, again, he's proposing to make it a 15% minimum tax on corporations that have book profits over $1 million. Assuming your regular tax is not less. That one's actually super interesting only because it's based on book profits, which I believe that's the only provision in the tax code that would refer to a book profit as opposed to a tax profit. Just interesting from a theoretical standpoint.
And if anybody has that problem, then Karl and I definitely want to speak to them after this presentation.
The 100 million in profit, yeah. For sure. Currently, there's no Made in America quotes credit, and he's thinking about an advanceable 10% tax credit relating to domestic manufacturing. This sounds a lot like the old DPAD, which was the domestic production activities deduction. It was 9%, but it sounds like it's a credit, which is better, and it's 10%, which is a little higher than the old DPAD deduction. Next slide, please. Okay, on the international side, again, I'm not sure how well this applies to everybody here, but the GILTI, which is that global intangible low income tax, it's currently at 10.5%. He wants to increase it to 21%. There are no currently direct or indirect incentives or disincentives for sales to US customers from foreign entities. So for example, you could have a company out in Bermuda selling into the United States, and it's taxed the same way a company in the United States would be taxed. Biden's looking to get a surcharge of 10% on companies that manufacture stuff overseas and then sell into the US. The last one here on the list is there's no direct or indirect incentives or disincentives for moving jobs overseas. So again, you could have a manufacturer that's in Connecticut where the wages are high and he wants to move out to, I don't know, India, where the wages are much less. Biden is looking to discourage that by having a clawback provision that will reduce tax benefits and basically penalize people for moving jobs overseas. Next slide, please.
So now we're going to get into a bit of the estate and gift tax planning or gift tax reform that Biden has proposed. And this can be, this is a game changer for a lot of people. So right now, for 2021, the federal estate and gift tax exemption is 11.7 million, double for married couples. And again, that's one of those sunsetting after 2025 provisions of the TCJA. Biden, so just what that means is that you can actually give away $11.7 million of assets to anyone you want without being subject to the estate tax or the gift tax. Biden would reduce that exemption to $3.5 million per taxpayer with regard to the estate tax, and reduce that exemption to 1 million as it relates to the gift tax. He'd also raise the highest estate and gift tax rate to 45% from 40%. But the biggest game changer is right now, when a person dies, the assets inherited by their beneficiary received what's called a stepped up basis to fair market value. So for example, if I bought a share of Google stock for $10 and it's worth $100, if I were to sell it, I would have capital gain on $90 of gain, the 100 minus the 10. When I die, my beneficiary gets a stepped up basis in that share of stock to $100. So that if that beneficiary sold the stock the following day, that beneficiary would have no gain because he would receive $100 of cash on the sale, and his basis for purposes of determining that sale would not be $10, but will have been increased to $100. Biden is proposing to eliminate that step up, so that the beneficiary would suffer the same tax consequence the day after the decedent died as the decedent would have incurred had the decedent sold the share of stock before his or her death. What's unclear is whether, in addition to, if Biden preserves the step up, the cost of preserving that step, and it's not really even a step up, is that all the assets of the decedent would be marked to market, and tax would be imposed on the appreciation in those assets. So it's essentially taxing the unrealized appreciation in a decedent's assets at the time of death. And just, going back to what we said earlier, if that, appreciation triggers a capital gain in excess of $1 million, you're not paying tax at the 20% rate. You'd be paying tax at the 39.6% rate, assuming that piece of Biden's tax reform passes as well. It also creates a problem for estates that have illiquid assets. So if you own a farm and that farm is very valuable, but you bought the land when it was not that valuable, or you didn't pay much, you will have to, the beneficiaries of the estate will have to pay tax on all that appreciation. And, land is not a liquid asset. So where are the beneficiaries in the estate getting the cash to pay that tax? So that remains to be seen. Next slide. So with retirement, right now, contributions to pre-tax contribution retirement plans like your 401k, your traditional IRA, are fully deductible. And when you think about it, that provides a greater tax benefit to high income earners in higher tax bracket, because it's better to get, if I'm in a 39.6% tax bracket, the benefit to me of making $100 contribution is $39.60, whereas for somebody in a 15% tax bracket, the benefit to them is only $15. So what Biden proposes to do is equalize the tax treatment of defined contribution accounts by providing a flat credit of about 26% to replace the deduction. So what that would mean is that the contribution would be included in income. It wouldn't be pre-tax. And somebody who earns $600,000 and makes $1,000 contribution to one of these retirement plans would receive the same $260 credit as somebody who earns $60,000 and makes the same $1,000 contribution to one of these retirement plans. And that's what I mean by equalizing the tax treatment.
Yeah, so let's talk about real estate real quick. So I had mentioned it kind of earlier, alluded to it, that under current law, capital gains for like-kind exchanges are deferred. That means if you have a rental property, you sell it and buy a new rental property, I'm very simplifying the rule here, you wouldn't have to pay tax. You would roll it into the new property. Biden wants to eliminate the deferred tax benefit for like-kind exchanges with investors whose income is over 400,000. There's that $400,000 number again. Again, you think it's kind of not very often. I actually just had a like-kind exchange that closed at 11 o'clock this morning. A farm gave up their conservation easement, their right to develop to the town that they live in exchange for more land adjacent to their farm so they could farm more. So it happens more than you think. The last one on here is the qualified opportunity zones. Again, it was in place in 2016, I think effective for 17. But anyway, it was to spur development into distressed areas. Biden wants to basically reform it a little bit and make sure that there's a clear economic or social or environmental benefit to the investment in that area. Again, this is super interesting to me because you're tacking on some social or economic motives to the tax law. So how you measure that and how you determine which ones are meeting it is going to be a very sticky situation for him. Next slide, please. Okay, so now we're into the state part, and what you need to know here is all the rules that we've been talking about were federal rules. The states have the right to conform or not conform to the federal rules. And Mark, you can help me out a little bit because you were mentioning the state of New York, I believe, just decoupled from the PPP rule that we talked about. So before I get there, let's go through what we're talking about. On December 27th, excuse me, the federal government or the Congress made it clear that relief from the PPP loans, the forgiveness of the PPP loans was not taxable. There was some controversy in the past, but the government came back, clarified and said, nope, it is not taxable. Correct me if I'm wrong, Mark. Did New York just come back and say that we are not going to recognize that, we're going to tax it?
No, well, I don't know about that aspect, but New York had said they weren't going to follow the CARES Act. And what that meant in terms of the PPP loan is that although that forgiveness is not taxable income at the federal level, by not following the CARES Act at the New York level, that income is considered cancellation of debt income and increases your New York taxable income. New York just recently, within the last week and a half, did a 180 and said that they will now respect at least that aspect of the CARES Act, that forgiveness for the treatment of forgiveness as not being considered COD income at the federal level will also not be treated as income for New York taxable income.
Got it. So right. So the bottom line is we have 50 states. So each state can choose to make their own rules with regard to the rules that have been passed, through the TCJA and the CARES Act and the CAA. Yeah, awesome.
Right. I'd also
Um,
say that some states, adopt the Internal Revenue Code as of a certain date, like Massachusetts adopts the Internal Revenue Code for personal income tax purposes. I want to say as like 2003.
Right,
So anything that comes after that, Massachusetts would actually have to proactively adopt into its tax regime in order for it to apply for Massachusetts personal income tax purposes.
right. Especially even with the states and the estate tax and the step up and all that sort of stuff. Yeah. I agree.
Yep.
The third one down, oh, I'm sorry, I'm gonna go back. Okay, the third one down on the list is, again, an interesting one in my head because it has to do with nexus issues and the pandemic. So I'll give you a quick example. My brother works in New York City. New York City, everybody was abandoning ship back in March and April. He went to Martha's Vineyard. He worked in Martha's Vineyard from March all the way through October. Well, if he's in Martha's Vineyard, is that Massachusetts source income or is that New York source income? And the rules depend on what state you're in. There are 5 states, New York happens to be one of them, but there are 5 states that use a convenience of the employer test. The other 45 states do not. So you can wind up with a really weird situation where you're either getting taxed in no state or you're getting double taxed, depending on which 2 states we're talking about. And then,
Yeah, just to follow up on that, New Hampshire is actually suing Massachusetts right now because New Hampshire does not have a personal income tax. And when COVID hit, workers that were commuting into Boston every day stopped commuting into Boston and started working from their home in New Hampshire. And Massachusetts said, whatever rule applied for tax purposes before COVID will continue to apply during COVID. So that if you worked in Massachusetts and paid Massachusetts tax before COVID, even though you lived in New Hampshire, you still have to continue paying Massachusetts tax, even if you no longer, are sitting at your desk in Massachusetts, your desk in Boston. And New Hampshire has now sued Massachusetts saying, how can you tax our residents when our residents are sitting at their home in New Hampshire? They're not stepping foot into Massachusetts to work.
right,
And Connecticut and New Jersey have actually signed on to that by also filing briefs with the Supreme Court, arguing the same thing. For them, it's a convenience of employer test. But, essentially, how could New York tax you as though you're sitting at your desk in New York when you're actually sitting at your home, somewhere in Fairfield or New Haven County? So it remains to be seen. It's a huge issue for both employers and employees in terms of determining their state tax liability and where they have to file.
correct. And just put some backdrop on this, just think about it. So I heard on the radio a week ago that 1 in 3 restaurants in New York City are now out of business. Think about the sales tax, the payroll tax that the states are losing on that, the unemployment tax. So Connecticut's no different. The states are struggling for funds. I mean, their revenues are way down. So it would not surprise me if they start doing things like decoupling off of the federal rules or getting aggressive at the nexus rules because you're working in the state. Again, it would not surprise me at all because they're looking to shore up their resources as much as anybody else is. Next slide, please.
Yeah, and just before we get to that, Connecticut has said, so the Connecticut had a number of tax reform provisions. Like there's this capital stock tax that corporations pay. It's one of 2 regimes that corporations pay tax on. That's supposed to be phased out over the next couple of years. Connecticut has thought about delaying the expiration of that tax because they are so hungry for funds.
Because delaying a cut isn't increasing the tax.
Right. All right. So just some income tax planning. We talked about Biden potentially increasing the individual income tax rates. And if you think the rates are going to go higher, and we'll talk about what we think is the timing of any of this reform, you want to pay bonuses sooner rather than later. If you are receiving installment payments. For example, a lot of my clients that sell their businesses for large amounts of money don't get paid a lump sum at the closing. They get paid a portion of the sales price over a number of years. You could accelerate the receipt of the, even though you're not receiving the funds, you can accelerate the gain as though you had received the funds into the current year rather than paying tax on the gain as you receive payments. Roth conversions, when you convert from a traditional IRA or to a Roth IRA, you have to pay tax on the appreciation. If you think rates are going to go up, you may want to, pay tax now. Also, that $1 million thing with the 39.6%. If you have over $1 million of appreciation, you might want to do a Roth conversion. You might want to convert, to a different entity. For example, if you're a corporation with the rate going up potentially to 28%, maybe you want to convert to a pass-through entity such as an LLC or an S corporation. The only advice I would give you is, don't let the tail wag the dog. If you weren't going to sell your business in 2021, don't do it just because you think rates may go up. It's got to make business sense as well as tax sense. With alternative investments, if you think rates are going up, you might want to think about changing your investment portfolio to include some tax-free municipal bonds. You may want to change from dividend to non-dividend producing investments if that rate on dividends goes from 20% to potentially 39.6%. Next slide. You always, just as a general rule, want to accelerate deductions. Paying less tax in the current year is better than paying less tax in a future year. You maximize charitable contributions, maximize retirement contributions, particularly if Biden goes the route of equalizing contribute or the credit for contributions to retirement plans. Things like bunching. Because the standard deduction is currently so high, many people don't get a benefit for charitable contributions. Maybe you want to double up on those so that with the property tax and charitable contributions and medical expenses, you exceed the standard deduction and can benefit from that. Next slide.
So just to continue on the vein of income tax planning, again, remember if there's a limitation on your state and local taxes of $10,000 in 2021, maybe you want to postpone some of your real estate tax payments to 2022 when and if the limitation is lifted. That would be your normal December payment that you can make in January. That's a no-brainer there. Do you want to restructure your compensation to minimize Social Security tax? We kind of talked about this before. If the Social Security tax comes back at $400,000, do you want to cap it at $400,000 and do some equity transactions or compensation or some deferred compensation or some other than compensation payments out? Maybe look at your rent because your rent is too low and you're going to pay rent to your LLC instead of paying compensation out. The third one down, consider triggering the inclusion event for the qualified opportunity zones. Again, this is if you're in a qualified opportunity zone, you can trigger the gain early because if the tax on the gain is going to increase to 39.6, it's no different than selling your stock early. Maybe you want to trigger that. 1202 is a code section that is pretty nifty in that you can exclude some of the gain on a small business when you sell your business. So think about it, if the capital gain is going to go up to potentially 39.6% ordinary rates, 1202 is going to be more and more important because it's a way to get out of not only a 20% tax, but a 39.6% tax. The last one is think about contributing to a Roth style account rather than a traditional account. Mark had talked about if high earners receive a 26% deduction on contributions to qualified accounts and they're really in a 39.6% rate, they're really still paying an extra 13.6% on those contributions. Roths are not deductible, but they're not taxable when they come out. So if they're not taxable when they come out, you're essentially saving the 39.6%. You're just saving it on the back end instead of the front end. So again, rethink where you're putting your retirement funds.
Well, I
Next
think
slide.
just to add a little color to that, what really this is getting at is if they do the equalization thing where you pay, you get the income tax credit of 26% and are paying 13.6% because of the leakage, when that money comes out, you're still paying 39.6% because distributions from traditional style retirement accounts are taxed when they come out. So you're
Right.
paying
You're paying
13.6
twice.
when it goes in, right? And you're paying 39.6% when it comes out versus a Roth account where you're just paying the 39.6 at the time you make the contribution.
Right.
So it's a difference of 39.6% tax versus a 53.2% tax when when you think about it.
Thank you. I probably didn't explain that correctly. All right, next slide. So for estate planning, again, we have to obviously keep an eye on this. The $11.7 million of estate and gift tax can be used before it expires. So again, if anybody has $11 million that they're looking to give away, I'd be more than happy to volunteer to take that gift to use it before the tax kicks in. That's, just look me up. My email's in the slides.
So
But
is
but
mine.
in reality, I mean, again, if you've got money that you're going to give to your children and anyway, why not give it to them now instead of waiting until later on, and you can save potentially millions of dollars of tax on that. Second one down, do you want to trigger a capital gain now at preferred rates rather than waiting to step up at death? If you're going to pay tax on the appreciation now, why not? Or even better, maybe you can do it over time. Maybe you do it over the next 5 years, and then you're never over the $400,000 higher rate on the capital gains. So again, it's a matter of thinking about what your goal is and then making your tax strategy appropriate for it. The last one is, it says take advantage of extremely low tax rate and depressed values. So there's, oh boy, we kind of skipped the GRAT comment, Mark, but there are things that you can do right now in the tax rules. And I don't want to get too fancy with the trusts, but where you can give away money and pay very little or no gift tax. GRATs just happen to be one of them that I'm thinking of, where you can basically give away, let's say $1 million, you get a payment back. That payment stream is discounted to you so that whatever's left over in the end, I'm doing a bad job of explaining this, but whatever's left over at the end of the GRAT will go to your children that could be potentially tax-free. So I guess the takeaway, and maybe Mark, you want to elaborate a little bit, but the takeaway is the low interest rates right now are making the gifts easier to give away at a lower rate, a lower hit to your income, to use up less of that 11.7 right now.
Yeah, or put another way, because of depressed values, you can transfer more assets and still be covered by that $11.7 million than you would be able to, let's say, post-COVID, when values actually reflect, real current, what things actually should be valued at if COVID doesn't exist. So you might be able to give away, an interest in your business, 50% of the interest that, yesterday or before COVID was $11.7 million. Now you can give away 75% of your business, because that same 75% of your business is still worth that same $11.7 million because of the depressed values. Just as another simple example, loans to family members. It's an easy way to give something without it being treated as a gift. I give Karl a $1 million loan. He pays me interest at 1%. If he can make more on that $1 million by investing it than the 1%, the difference is his to keep without having to pay a gift tax on that differential. So those are just some simple thoughts about, taking advantage of low interest rates and depressed values. And there are estate planning techniques also that can be used to take advantage of those two, low interest rates and depressed values.
Your verbal contract is accepted. Thank you.
You got it. All right, so the timing of the tax law changes, um, as we said before, we know the makeup of the Senate is now, 50-50, but it's not clear that, every Democrat or an independent is going to sign on to tax relief, so that, Camilla Harris can just break the tie and things can get passed through. As we all know in the papers, Joe Biden is trying to pass a $1.9 trillion COVID-19 relief package. Things like that will definitely take priority over tax reform. Plus, I would say until the economy gets back on track, it's probably not a great idea to, do tax reform. So I see tax reform, it will happen. I don't know what will happen, but it will happen in some fashion, occurring probably not until 2022 or later. We don't know the status of the pandemic. We don't know the status of the economy. And listen, there could always be another event that skips to the front of the line, like the mortgage crisis in 2018. If something like that happens, that's going to take priority over tax reform. Next slide.
Okay, so we're going to go over some of the CAA, you skipped this. Thank you. Consolidated Appropriations Act. Sorry, I know the acronyms, not the actual names. So these are the things that were passed on December 27th. They're relatively new. Next slide, Emma. The first one is the Paycheck Protection Program. So they expanded it. The first one ran out on October 8th. They expanded it as of January 1st, and it is, I guess, technically December 27th, and it goes through the 31st of March. So there is PPP2 is what the industry is kind of calling it now, available. The qualifying expenses with the PPP2 are much like the expenses for the first one, but expanded. So you use it for payroll. You can also use it for rent and interest and utilities, but they expanded it for personal protection. They put a quirky one in there where if you had damage from looting, you can use it for that. So again, enhanced the qualified expenses. They also did a second borrowing. There are certain provisions in there with regard to you have to have a decrease in your gross wages for any one quarter equal to at least 25%, and or you have to be in a certain category of company. By the way, Emma, they included Chamber of Commerce is now eligible for PPP. So you were not in the first round, you are in the second round. So it's a great little thing for nonprofits or people who didn't get the PPP in the first round to have a second bite at the apple, if you will. The PPPs are limited to $2 million of borrowing. I don't know anybody that got that much anyway. I don't know if that applies. And it's available for companies with less than 300 employees. And again, they must demonstrate that they suffered a downturn because of the pandemic, and they're defining a downturn as a decrease of 25% or more in any quarter of gross receipts, not net gross receipts. The period, the flexible coverage period, that's bars may choose the ending date of the PPP covered between 8 and 24 weeks. Again, it's kind of the best of both worlds from the first round. And then there's a simplified forgiveness process, and this one I'm actually dealing with a lot right now. The first round PPP1 was anybody under 50,000 could use the 3508S for simple form. Now it's anybody under $150,000. And essentially what that did was it went from about 67% of the loans to about 83% of the loans now are covered by the simplified process. So they're trying to make it easy for you. Next slide, please.
So we're running up against, a little bit of a time crunch. So I'm just going to run through a couple of slides pretty quickly. This one's an important one. This is the employee retention tax credit that I talked about earlier, where employers that paid wages despite COVID challenges could get a credit of 50% of the wages paid up to a certain amount. Now that credit is equal to 70% rather than 50% as it was under the CARES Act. You used to not be able to use this credit in conjunction with a PPP loan. You had to choose whether to take the credit or obtain a PPP loan. Now you can use both the credit and the PPP loan, as long as you're not using the same wages for both a qualifying expense under the PPP loan and qualifying wages for purposes of this credit. It was the case that you had to have demonstrate a 50% reduction in gross receipts during a calendar quarter relative to a calendar quarter in the prior year. Now you just have to show a 20% reduction. The wages that are creditable were $10,000 a year per employee. Now it's $10,000 a quarter per employee. And the employees, it used to be have to be a business with less than 100 employees. Now you can have a business with less than 500 employees and still qualify for this credit. Next slide. This first bullet point got some, press, the 3 martini lunch. Business meal deductions were capped at 50% of the expense. For 21 and 22, that deduction is 100%. And that includes not just eating in a restaurant, but if you take out from a restaurant or have delivery from a restaurant, those expenses also qualify for 100% expense deduction. Paid sick and family leave credit, those are credits that an employer got for paying its employees who had to take a leave of absence for their own COVID challenges or COVID challenges of a family member. That credit was mandatory through December of last year. It is not mandatory anymore. You don't have to give the paid sick and family leave anymore, but you can voluntarily choose to do it. And if you choose to do it, you are eligible potentially for that credit. The deadline for payroll taxes, as I said earlier, President Trump said he was going to suspend the employee portion of Social Security tax, 6.2%. That could be deferred. That deferral was through April of this year. It is now allowed to be deferred through December of this year. And lastly, economic injury disaster loans. You were entitled to an advance on that loan, even if you wound up not qualifying for that loan. But that advance, because it was not taxable to you, had to be deducted from your computation of PPP loan forgiveness. That advance no longer has to be deducted. And last slide.
So this one, just real quick, for all the Connecticut people, I'm assuming we know by now that the Connecticut paid family medical leave started as of January 1st. There is a 0.5% coming out of your employees' wages that's getting remitted to the state of Connecticut to fund the family medical leave pool. The pool actually doesn't open for benefits until January of 2022. The concept is if somebody gets sick, or if somebody has a baby in the family, or a disastrous medical consequence where they can't work, they can draw out of this pool to supplement some of their income. So I think that's as far as I want to kind of leave it right now.
Yeah, I mean, the only thing I would add, I'd add 2 things. One, it applies to any employer with 1 employee or more. And the other thing is there's an exemption for employers that offer a similar plan independent of the state plan with benefits that are at least comparable to the state plan.
Ironically,
so
which is
every employer in Connecticut is subject to this new Family and Medical Leave Act.
Ironically, except for the state employees.
Well, with that, once again, Karl and I, want to thank you for joining us for this hour. Emma has kindly agreed to circulate the slides to anyone that registered for the program. You will see the contact information for both Karl and me on the first slide. So, we didn't get to your questions, unfortunately, but if you have any questions, feel free to reach out to either one of us. And have a great afternoon.
Yes, thank you, everyone. You should expect an email in your inbox within 24 hours with that information and a full recording of this session. So thank you, Mark. Thank you, Karl. And thank you for everyone that's joined us today.
Thank you.
I know.